Thank you, Steve. My name is Doug Skinner. I am the Director of Business Intelligence here at AFS, and I'll be moderating our session. Thank you all for joining us today. We have a great session for you this afternoon. Obviously, there is a lot of interest, a lot of concern really about credit conditions across the country right now. Fortunately, AFS and RMA have been aggregating and benchmarking commercial lending data for almost 20 years. And that gives us near real-time insight into trends in credit risk. To help us interpret what is going on, we are fortunate to have with us today two experts in the field. Brad Cunningham from Commerce Bank. Commerce is a $32 billion commercial banking organization out of Kansas City. And Tom Cronin, who is the program manager for the RMA AFS Risk Analysis Service. Brad and Tom, thank you so much for sharing your thoughts with us today. We have a number of topics to cover, so let's jump right into it. Let's start with loan growth. The results coming out of third quarter bank earnings calls have not been favorable. Tom, why don't you start and give us a sense for what is going on from a commercial growth standpoint?
Sure, Doug. First, let me say it's a pleasure to join you and Brad today. These are very interesting times. This chart is looking at year-over-year growth. So, for example, August 2020 versus August 2019. And if we look at what's been happening with outstanding since March of 2020, and we split the balances by C&I and CRE, we're seeing that these markets are going in opposite directions. And whether you look at C&I participations, the green line, or bilateral loans, the blue line, both jumped in March as companies drew down on lines of credit and bumped up their cash in face of the uncertainty with the virus. Subsequently, those lines were repaid and balances are dropping. CRE, however, has remained positive and steady, especially for the industrial and multifamily segments.
And Brad, is this consistent with what Commerce is seeing? Are there any particular segments or industries where you expect to see loan growth in the coming quarters? And maybe you could also talk specifically about the role the Paycheck Protection Program played in meeting customer needs at your bank.
Yeah, thanks, Doug and Tom. Looking at this chart, I think that's very indicative of what we're seeing at our bank. We did see a lot of borrowers take large draws at the end of the first quarter due to liquidity concerns. Would they be able to make payroll? So they advance on their lines of credit. And then in the second quarter, we saw a lot of those borrowers pay back down. And obviously, as Doug mentioned, there was some PPP loan growth in the second quarter, but not a lot of just organic loan growth. Talking about what we kind of expect to see over the coming quarters, borrowers right now are still limited spending on CapEx, even in a low interest rate environment. M&A activity has been pretty slow in 2020, although there is some anticipation of some M&A activity growing in 2021. So we'll see if that plays out. Specific sectors, especially in CRE, Tom mentioned multifamily and industrial as two areas where we might see some loan growth, and I would echo that. Home building is another one that I would point to. Over the last 10 to 15 years, we saw a lot of individuals moving back into the inner cities, into the central business district areas of cities. And I think with kind of what's gone on over the last 6 months between the coronavirus and people wanting to be not right on top of each other, as well as some civil unrest we've seen in some cities, coupled with low interest rates, we're seeing kind of a reversal of that with borrowers or individuals moving out to back to the suburbs. And so home building has stayed extremely strong and steady through the last 6 months, which is kind of converse to what we saw during the last recession. As it relates to PPP, there was obviously a lot of demand for PPP loans. Our bank in particular primarily focused on existing customers and helping them to get the money they needed. But we were also able to be selective in identifying new customers that needed the PPP money so that we could start a relationship with them. And we've seen a little bit of loan growth come out of that already. And we hope that will continue into 2021.
Tom, a lot of people are understandably concerned about borrower cash flow and loan performance right now. Can you talk about what we are seeing at a national level in terms of trends in non-performing commercial loans?
Let's start with short-term delinquencies, which is the blue line here. And as businesses were shut down in March and April of 2020, we saw historic highs in the 30 to 59 days past due of almost 1.5%. Now, since that time, the delinquency rate has been very volatile, and while it is now below 1%, it is still in the range we saw during the recession. Meanwhile, non-accruals continue to climb, especially for loans to oil and gas extractors, restaurants, arts and entertainment. And within arts and entertainment, we're seeing elevated non-accruals for dinner theaters and fitness centers.
Thanks, Tom. And Brad, what has Commerce Bank's experience been so far? And what specifically are your expectations for the rest of this year and early 2021?
Yeah, this is a very interesting topic. It's been very hard to read bank results over the last 2 quarters because there's been so much aid in delinquencies from payment deferrals and PPP money and things like that. Obviously, at 6/30, delinquencies remain pretty low. We're starting to see 9/30 numbers also not spike too much, probably lower than we would expect. And again, a lot of that is due to the payment deferral programs. If you think about when those started, most of those started back in about April of this year. A lot of banks were giving 6-month deferrals, so those would be running out in September, meaning those borrowers would be returning to payments in October. So the 9/30 number still would not be reflective of borrowers that were past due that may have gotten a payment deferral. So while we know 6/30 numbers were pretty strong, 9/30 numbers may creep up a little bit, but still not too bad. I think 12/31 and then maybe even the first quarter of next year is when we'll really get a full sense of what the impacts are. And a lot of that is just dependent on kind of what happens. Are we going to be able to fully reopen our economy again? Will there be additional round of stimulus coming from the government, things like that? So while I do expect numbers to creep up 12/31 and into the first quarter, still at 9/30, we're still staying in a reasonable range.
Tom, Brad mentioned deferrals. We're all watching this kind of national experiment play out in terms of banks granting widespread payment deferrals, and I'm not sure any of us really know exactly how it's all going to turn out. Can you give us a sense for what is going on at a national level?
So these charts are from 2 poll questions that we asked during our recent webcasts. On the left, we asked what percentage of commercial loans were given deferrals. And you can see that over 40% of the banks indicated their deferrals were above 10%. That's the red slice of the pie. And another 30% said their deferrals were at least 5% of their borrowers. So all in all, 70% said they had deferred at least 5% of the borrowers. A few months later, as the initial deferrals began to expire, we asked how many companies would be given a second deferral. And more than half of the banks responded that less than 25% of their companies that received an initial deferral would get a second deferral, shown here on the right-hand side chart. And then while not shown, the criteria for that second deferral, we've heard will not be as liberal as what was granted the first time.
So Tom, would you say more of a wait and see approach for the second round? It sounds like the banks will be applying more scrutiny to requests for a second deferral. Would you agree with that based on what you're hearing?
Yes, I would. What we've heard is that the initial deferrals were given to just about anybody who asked. This time, that won't be true.
And Brad, how do these results compare to Commerce Bank's experience and other banks in your market area? And maybe if you could talk about what you think the regulatory expectations might be going forward.
Yeah, these results are very much in line with what we've been hearing. Most of our peer banks, we think, are running in that 10 to 15% range on cumulative deferrals. At Commerce, we're running just over 8%. I think we're a little bit lower than our peers. We don't have quite as much exposure in some of the heavily impacted industries that are really feeling the stress from COVID. But turning towards the second round deferrals, the last 2 quarters, the primary focus coming out of earnings calls has been on cumulative deferrals. And as we get into 9/30, the focus has been much more on borrowers still actively in deferral. As Tom mentioned, the first round deferrals were given out almost without hesitation. But there has been a lot more scrutiny on the second round, and a lot more focus paid attention to on which borrowers are still active in deferral. So as I mentioned on the last slide, most of these borrowers took deferrals in March and April, which means August, September, they're running out. So the borrowers that are still in a deferral period now are the ones that are probably most need to be concerned about. As it relates to regulatory guidance, I think the regulators actually did a really good job on this issue. They released guidance early. They gave banks basically a pause for 6 months to work with their borrowers. And obviously that's had a positive impact, not only on banks, but also on commercial borrowers. Banks being, giving the leeway to work with the borrowers and get through this tough time, because a lot of these borrowers were performing just fine before COVID and will probably be performing just fine as we start to exit or start to improve from COVID. But they just needed that 6 months or so pause as the country kind of shut down for a while. So regulatory expectations going forward, I think, will be more along the lines of, do you have your risk ratings appropriate? And then as we get into the new year, that's when we'll probably have to start reporting TDRs again on borrowers that are still taking deferrals.
Now, we know that the economic downturn and the uncertainty around the timing of a recovery has prompted many banks to begin the process of regrading their loan portfolios. So Tom, can you talk about what we're seeing so far from a risk migration standpoint?
So 2 charts here to look at that. Using the RMA 10-point risk rating scale, the chart on the left shows the long-term trend for special mention, substandard, doubtful, and loss, or criticized loans. And we saw significant increases in April, May, and June of this year in the overall percent criticized rate. Now, most of this increase was in loans rated special mention, continuing a trend that actually started in late 2018. But for July and August of 2020, the percent of loans rated special mention in particular and criticized overall has stabilized. Now, the chart on the right shows a ratio of downgrades versus upgrades, looking at all risk ratings, not just criticized loans. And up until June 2020, downgrades were slightly ahead of upgrades. But most recently, you can see downgrades far outpacing upgrades by over 2.5 to 1.
So Brad, how does a bank go about evaluating borrowers' risk ratings during such an unprecedented event like a global pandemic? Are there some best practices you could share with our listeners today?
Yeah, these are truly unprecedented times, not just in the economy, but as it relates to risk ratings. When you couple the velocity in which the economy fell off the cliff back in March and April timeframe, and then also the uncertainty that we have even still today, 7 or 8 months into this recession, it obviously makes risk rating very challenging for banks. Some of the best practices that we did at Commerce is, one, we established a specific risk rating just designated for borrowers that were impacted by COVID. We use this risk rating. It's not a regulatory risk rating. It does not meet the definition of special mention or substandard or doubtful, but it's a kind of a transitory rating where we were able to put these borrowers so that we could keep an eye on them and discuss them over the time period of COVID, and then make the ultimate decision whenever we had a better feel for how it was going to play out. When we established this risk rating back in March, we had the goal of decisioning each risk rating by the end of this year, meaning by the end of the year, we want to have that borrower either back to a pass grade or taken to a regulatory classification if required. And the way that we identified a lot of these borrowers is we identified 10 industries at the bank that we thought were going to be most heavily impacted. And we began discussing those borrowers at loan committee meetings to determine if they needed to be in this risk rating or worse, or if we think they're going to weather the storm, so to speak. And not only did we focus on those 10 industries, but we branched out to other larger borrowers or other borrowers we thought were going to be impacted. And by the end of it, over about a 2 or 3 month period, we ended up discussing about 33% of our overall loan portfolio to basically regrade and determine if they needed to be have more scrutiny on them. And then now that we have identified those, the larger borrowers that are in these risk ratings, we've been discussing on a monthly basis to make sure that we're staying on top of action plans and that it's progressing the way we think, so that we can make sure that the risk rating is still appropriate.
Tom, Brett mentioned differences in industries. Now, I would imagine that there are certain industries that have borne the initial brunt of this downturn. Can you give us a sense for those industries that have been most vulnerable so far to this pandemic?
So Brad mentioned he had a list of 10 industries, and the upper chart here, the chart on the upper left, shows a select group of 6 industries that at the outset of the pandemic were thought to be highly vulnerable. And here we display the August 2020 non-accrual rate for those industries versus the market average, which is in the dotted line. And energy loans are well above the average, and we're also seeing elevated levels for restaurants and arts and entertainment recreation. With the lower chart, we're showing special mention levels for all industries this time. And in addition to the poor outlook we've already mentioned for energy and arts and restaurants, the outlook for retail and transportation is also unfavorable. And within retail, the potential issues are with bookstores and department stores. And for transportation, the special mention loans are almost evenly divided between airlines and cruise lines.
And Brad, have you seen similar results in your markets? And can you talk a little bit about how you monitor sector risk at Commerce Bank?
Yeah, I would say the industries that we have our closest eye on fall very much in line with what's in these charts. Probably most specifically, hotels, oil and gas, and senior living. And we found even within those industries, different property types are performing differently. Hotels, for example, are hotels that are in more leisure type drive-to markets that are on interstates are actually performing okay, whereas the ones that are central business district oriented, that cater to the convention travel or the business travel, those are the ones that obviously are struggling more so. And as it relates to senior living, if the property had been stabilized for many years, those seem to be performing okay. But if you had a senior living property that was still in the lease-up stage, maybe completed in 2019 or completed in 2020 that is now leasing up, those are the ones that are obviously really having a hard time filling up, because not only are not many people moving into those facilities right now, but it's even hard to get tours arranged and things like that. So those industries are the ones that we're probably paying closest attention to. CRE retail is obviously another one that has been impacted quite a bit. Is the tenants in a lot of cases are getting deferred rent payments, and so in turn they have to come and ask for payment deferrals from the bank. And then 2 other industries that I would highlight that maybe aren't talked about as much. One is hospitals. You think of hospitals being extremely busy during this time because of COVID, but if you think back to the March, April, May timeframe, all of those hospitals had to stop elective surgeries, which are usually their higher margin type procedures. And so we saw a lot of hospitals have a liquidity crunch kind of early on in the crisis. It seems like now things have gotten better as they've been able to start those surgeries back up again. But that was an industry that we were really keeping an eye on for a while. And then another one is student housing, which is kind of a subsector of multifamily. And multifamily as a whole, especially in the higher property classes, has performed okay during this time. But student housing is a big question mark, because a lot of it depends on what school is it supporting. Did they come back in person full time? Are they going to stay in person full time? We saw a lot of students decide to live at home with mom and dad and take online classes as opposed to going back in person. So student housing is another industry that we're keeping a close eye on.
Our last topic today has to do with what we are seeing from an underwriting standpoint. The Federal Reserve conducts a quarterly survey of senior loan officers, asked them a variety of questions, and I understand that their most recent survey revealed some very interesting results. Tom, can you comment on the results of that Fed survey?
The blue line here represents the banks, and their willingness to lend. And then the green line is for the borrowers. And when the bank line is above zero, that means banks are looking to add assets, and oftentimes we see they relax credit standards. Conversely, when that line is below zero, banks are tending to de-risk and shed assets. For the borrowers, above zero indicates a desire to fund operations, but below zero indicates a hesitancy to borrow. And now, as you can see here, both are below zero, as banks are hesitant to add assets and borrowers are on the sidelines waiting to see what happens. So this does not portray very well for loan growth in the future.
And Brad, what was your reaction to these results? Did Commerce Bank institute any specific policy changes as a result of this downturn? And what are you hearing in terms of when we might start to trend in a more favorable direction?
Yeah, I don't think anybody will be surprised by the results of that survey. I think that's probably in line with what most people would expect. Even banks that may not have changed many policy changes or changed their underwriting standards are definitely having more thorough discussions on credit these days. It's much more difficult to get a loan approved, I would say. We kind of use this time period as an opportunity to revisit some of our concentration analysis, our hold limit analysis, and really take a deeper look at borrowers that have come to ask for, especially the second round of deferral. Are we able to get an additional credit enhancement? Can we pick up another guarantee? Can we get more collateral? Can we establish a cash reserve account? Things like that. So while we didn't really make any drastic changes to credit policy, we have changed the way we view some of our borrowers, and really taking this opportunity to restructure some of the loans to make it a little more favorable so that we have more comfort in, obviously, the ultimate repayment on the loans.
On behalf of Brad and Tom, I wanted to thank you all for joining us today. RMA and AFS conduct regular monthly updates on trends in commercial credit conditions, so be on the lookout for those webinars as well. Thank you for joining us today, and good afternoon.
Doug, Thomas, and Brad, thanks so much for sharing that important information. This concludes RMA's annual Risk Management Conference session, Risk Analysis Service, interpreting credit risk performance across the country. They will remain online for a few more minutes to answer your questions.